welcome everyone to the September Ag Economic Dialogue session. We've got a pretty good schedule of events for today, so I'm not going to hold you up very much. I'm Heather Gessner. I'm the Livestock Business Management Field Specialist. Jack Davis, our Crop Extension Field Specialist, is on hand as well. We also have two new employees in the SDSU Extension world, and we're excited to introduce them to you. So Sarah, your little picture box shows up first on my screen. So you want to just give us a quick introduction to you, and we'll go from there.
Thank you so much, Heather. I want to say hello to everyone. My name is Sarah Sellars, and I'm a new assistant professor and extension specialist in sustainable farm and food systems here at SDSU. So I'm new to South Dakota, new to Brookings, and really excited to be here. My interest in agriculture began when I was growing up on a family grain and livestock farm in West Central Illinois. And this led to me doing my bachelor's degree in agricultural economics at the University of Illinois. And kind of due to the opportunity to work with a professor there as an undergrad, it kind of influenced me to think about grad school and going even more into agricultural economics. So I ended up going over to Purdue University in Indiana, and I did my master's in agricultural economics. And then I came back to University of Illinois and did my PhD. So just finished that up in August, and now started my new job and learning a lot about South Dakota agriculture and things here. There's a lot of similarities with Illinois, but also a lot of differences too. So I definitely have a lot to learn. My previous work in Illinois, I developed an extension program related to agricultural carbon markets. So all of that, there was a lot of stuff going on, especially last spring. So I kind of developed some materials to help and assist farmers with that and making those decisions. I also have worked on cover crop adoption and nitrogen recommendations and nitrogen recommendation adoption by farmers. Those are things I'm really passionate about. I definitely view things from the farmer's lens. I'm a little bit biased, I'll admit, but growing up on a farm, I tend to try to view things from the perspective of the farmer. So my goal with my research and my extension is to develop really applied and useful tools that farmers can use. So I did a lot of work. There's a lot of interesting stuff with nitrogen going on in Illinois, some application. The new nitrogen recommendation we have in Illinois, not a lot of people are using it. So I've been working on trying to figure out why and trying to figure out how we can get people to start thinking about their nitrogen rate decision a little bit more. But looking forward to working on some South Dakota ag now, kind of switching gears. And if anyone has some ideas or wants to chat or wants to educate me about South Dakota agriculture, happy to talk and meet people, and love learning and working on applied stuff. So feel free to reach out.
Thank you, and welcome to the team. Hoanh, you want to go next?
Yes. So hi everyone, I'm Hoanh, a field specialist at Ness School of Management and Economics and SDSU Extension. A little bit background, I received my PhD in economics from the University of Houston last month. So August 2023, freshly graduate. My research interests include real estate economics and environmental economics. Those topics I work in my dissertation. I'm also a Jackrabbit alumni. As I mentioned earlier, I received my master in economics from SDSU in 2017. And then I worked a year at Great Western Bank as the Treasury Associate Quantitative Analyst before I joined the PhD in 2018. So I'm very happy to coming back here as SDSU as a different role and contribute my work to SDSU. Yep. And then a little bit about the work I'm doing as SDSU. So as you may know, SDSU has been conducting an annual survey on extension farm real estate market survey since 1991. So currently I'm working with Jack on doing the survey. However, we plan to do a little bit differently next year. So Jack and I are working on redesign the survey And also next year, we hope not only hear from the industry professional group, but also from the farmers, rancher, landowners. So what we're gonna do is we will do the survey both online and by mail. And I hope that if you receive the survey from SDSU, please help us to fill out the survey. Please help us to respond to the survey. That will help us to have a more complete picture about South Dakota agricultural market, agricultural land market, and also will help us to provide the audience with the more informative report. Thank you.
Yeah, it's good to have Han here. I look forward to the addition she can add to our land value survey and our ability to do more workshops in that area. So it's going to be an exciting year. So welcome to our team.
Thank you.
As both of them mentioned, if you have ideas or topics that you want to reach out, please, if you can't find them, let me know, and I'll get you their contact info, or look them up on our webpage, and hopefully all that's working the way it's supposed to. So with that, welcome to the team, to the two of them, and I think we'll get into the nuts and bolts of today. We are kind of breaking away from our SDSU extension presenters focus for today's sessions, because we wanted to make sure that you guys were getting timely information, and we wanted to make sure it was coming to you in the right manner. So we've asked a couple extras to come and join us today, and we're going to kick off the presentation. Colten is going to cover some of the pasture range forage insurance components, deadlines coming up. So we wanted to make sure everyone was aware of what that is, how it works, and all those types of things. So with that, Colten, the floor is yours. Oh, I guess one quick point of note, if you have questions, you can type them into the chat. Colten's interested if you have them and you want to jump in between time, we can do that too. Otherwise, I will turn the recording off at the end of both of the presentations today, and we can ask questions after that. So however you guys feel like doing it. Now I'll turn it over to Colten, and he can share slide with us.
Awesome. Thanks, Heather. Can you see my screen fine up here?
I can. Yes.
Perfect. Just a little bit about myself. My name's Colten Seegers. My family is originally from Indiana, around Gary area. My dad was a farmer along with his dad in that area. My dad took a huge risk down there and planted a uninsurable crop. He had an insurance agent, told him, I can guarantee you we're going to get a written agreement done for you this year. So you're good to go. Ended up getting 21 inches of rain in 1 week, and that crop was uninsurable. RMA turned that down, did not have a written agreement. So my dad ended up losing the whole operation there in Indiana. My grandpa at that time was looking at slowing things down, and he had bought cattle out in Winter, South Dakota since the 80s, and had always dreamed of having a ranch up in South Dakota. So told my dad hey, I'm looking at downsizing and rolling it into a ranch in South Dakota. Got my eyes on one, but I'm too old to manage it. Would you be willing to manage it for me? And my dad said, I absolutely have no other options. So I'm moving my 6 kids and one on the way out to South Dakota. So that's how I kind of got out here. From there, my dad inherited basically 2,000 acres of pure ranch land and converted about 500 to 600 acres of it into crop. Now there's a mixture of hay ground, hunting ground, and pasture on the place. From there, I've always had a little bit of connection with agriculture, but the operation was not in a place where I was able to come in on it, just not at that size yet. So I figured I'd get into crop adjusting. Did that for 4 years. Met my wife and was living in Nebraska with her while doing crop adjusting still up in South Dakota. Got a phone call from the company I was crop adjusting with and asked if I wanted to be an underwriter in Omaha, and was not excited about Omaha. I've always been a small town guy myself, but had to keep moving up the chain. Did that for 2.5 years and got a phone call from Farm Credit Services of America and asked if I was interested in being an agent for them. Said absolutely, 100%. Let's get in the small town. And now my wife and I have a 7-month-old beautiful baby girl who is a handful and refuses to sleep. But now we're back here and I'm helping. And my goal is to make sure that farmers don't have the experience that my dad did in Indiana. So that's a little bit about myself on there. What we're going to be talking about on my end is pasture, rangeland, and forage. We refer to it as PRF because we love our acronyms in crop insurance. So the question is, what is it? This is a quick overview. We'll get into the nuts and bolts on it. There's a lot of moving parts on this. However, broken down very easily, it covers rainfall. And that's the only thing it does. It doesn't cover drought, doesn't cover how it winds. It just covers what is the expected rainfall in your grid, and do you meet that expectation? We insure hayland grass or grazing grass. They did open that up to now you can actually insure your alfalfa hay ground as well in there, which is a huge benefit to guys. It's highly subsidized. Making it about 50% subsidy. I have a couple of my policies that are actually 51%. So that 1% makes a huge difference, but 50% is a very big benefit. There are very few policies in multi-peril that actually come with that kind of subsidy. It's an area plan. It starts when the grid records below a 90% average rainfall, read by NOAA. One of the things to keep in mind, we'll get into this a little bit more, is you have to have a minimum of 2-month intervals selected. And we in Farm Credit, we usually run the 5 to 6 month intervals. An interval is 2 months put together. So you have to have a minimum of 4 months. We like to spread it out throughout the whole year. You're planning on utilizing that full year on that pasture, so we should get you coverage for the full year. One thing to keep in mind, and this is what Heather said, it's kind of, we're talking to guys about it right now, and I'm talking to my current existing customers of how do we optimize this for you? How has it worked in the past? Because we have a sales closing date coming up December 1st. Sounds like a long ways away, but in insurance, your days and weeks go by very fast. Before you know it, your sales closing date's arrived. And one of the huge benefits that guys really like, there's no need to file a claim on this. It's automatically done through RMA. Once they get all the data collected, if there is a shortfall in the precipitation, a check automatically goes out. There's no need for an adjuster to audit anything. There's no need for us as an agent to open up a claim, and you as the farmer, you don't have to track your own rainfall and say, hey, I think I'm short. Here's my data. It's all automatically recorded for you. So how does it work? Precipitation is measured in the completed interval. So for instance, if we had you in a January, February, so that was your first 2 months. Once February 28th was completed, RMA would then collect that data from multiple sources. RMA likes to hold that close to the chest of where does the data come from. It has been leaked that it comes from local sources, as well as weather stations, NOAA, and there's some debate whether they use COCORAs as well in there. Nobody knows exactly, other than we know that they use weather stations and NOAA for sure on those. RMA is allowed 60 days to complete this data collection. In the past, they would usually take about 30 days. Now, as typical federal government does, they take the full extent of the 60 days and sometimes a little bit more. So if you were to have an indemnity in January, February, we would probably see you have a check come, that would be April or the beginning of May. One of the things that I get asked a lot of times is, do I need ownership of the cattle, or can I just rent out my pasture and then give it to someone else? They changed it to where that you need to have insurance. You can only insure the ground that you actually have ownership of the cattle on, and it also has to be ownership of your ground or ground that you're renting that someone else is not insuring for PRF. So if you have a 50-50 split in the cattle, or you have to have some form of interest in the cattle that will be grazing on there. Each grid has a different history. So I'll show you kind of what the grids look like. They're divided up in they're using longitude, latitude lines. They come out to about 12 by 12 miles rough up north where we are at. So each one has a different history on there. So we like to utilize your 578s, your producer prints, to verify where your acres land in those acres. And then I can actually look at the history and optimize this best for you. One of the nice benefits with this in multi-peril, if you plant corn and you have a corn contract, you have to insure every single acre of corn out there. On PRF, you can pick and choose which acres you want to have insured. If you have 200 acres that are kind of off on their own, you're like, you know what, I don't know about PRF, I don't really trust it yet. I'm going to leave those 200 acres off, but I'll insure my other 1,000. You are well within your rights to do that. And again, the sales closing date is December 1st. So as I mentioned
Colten,
earlier,
we had a question come in quick.
absolutely.
You brought up the alfalfa being able to be insured.
Yep.
And so the question is, what percent alfalfa compared to grass can you insure? For example, if you have 30% alfalfa, 70% grass, are you insuring just that 30% of the alfalfa?
So what you would be insuring, they would call that a hay grass mix. Because you can insure grass hay, there's really not going to be a huge difference in there. They're going to give you a straight across the board flat rate on the county. So whether that's alfalfa ground or whether that's grass ground, you're going to have a flat county base value on there. So if you do have something like that where it's 30% alfalfa, 70% grass, it's still going to have the same base rate. Does that answer that question for you?
Thanks.
Okay. So as I mentioned earlier, you must select at least 2 intervals in the year. So this is going to come out to essentially 4 months. You cannot select more than 6, which makes sense. You are insuring the full year, 12 months, and it starts over again. So we're in a world that changes constantly, but one thing that is still the same last time I checked, we have 12 months in a year. I hope that doesn't change because that would make my life interesting. We're going to divide percentages of acres in the intervals. So you cannot have lower than 10% and you cannot have higher than 50%. So if we were to select just 2 intervals and we're just going to go all in on 2 of them, we think these are the highest paying ones, we're going to go 50-50 split. You can't go, ooh, I like January, February because it's got a great loss ratio. Let's put 90% there and 10% in another one. It has to be no more than 50 and higher than 10%. And that's why we kind of like to utilize spreading that out throughout the whole year. You can select coverage levels. So this is going to be how much of the expected rainfall are you wanting to cover. So we're setting a deductible on that. For easy math, if we are expecting 4 inches in your interval, and we set your coverage level at 90%, which is where most of them land, your expected trigger line would be 3 and 3.6 inches for that interval. Once we fall below 3.6, you'll see an indemnity start to be triggered. The other thing that comes in here, and this is the really cool part with PRF, excuse me, we're able to select a payment factor. This goes from 60% of the county base value all the way up to 150%. So we're able to get an extra 50% of coverage on what the county is saying the base value is on that ground. So whether that be grazing or hay ground. Now, the benefit on that is most of the time when I talk to most insureds is federal government doesn't recognize how much my ground is worth. And they always put it lower than what I think it's worth and what I'm actually paying into it. So moving it up 50% allows us to kind of get a leg up on that. That if you do think that it's below the standard that you need to be at, you can actually increase that. So we mentioned kind of what grids. Everyone's very familiar, I would assume, of what section lines look like and how everything's broke out. And this is the one thing guys kind of get a little bit, have a lot of questions on when I start talking to them because, well, my stuff's in section 16. Well, the grids, we don't care about your sections necessarily in this. We care where your sections land in the grid. So, for instance, this is just a quick screenshot here. We've got Pierre up in this area. And then down here, I work a lot in like this Draper, Murdo area. A lot of these guys land in grid 28,618. And I can't read that one, but it's like, I think that's 28,617 is where a lot of guys land out there. And so for instance, if I had a guy that was farming on the edge here, and he had pasture on 28,618, as well as in 617, we would be able to insure these on different intervals. They don't have to be on the same. So that's one of the huge advantages. If you cross lines, we can insure these on the opposite of what 617 would be. And I'll show you kind of what a policy looks like later on in this presentation of how we can optimize that. But it's something to keep in mind of when we're looking at where your acres land. We need to know where your grids are at and what the history is, and how can we optimize it to spread that risk across the whole year. So I mentioned earlier that one of the things we know for sure is used is weather stations to measure that precipitation. Because when we're measuring a 12 by 12 grid, we run across a lot of times where my neighbor got 1.5 inches last night and I got 1/4 of an inch, because South Dakota is funny like that and we get crazy storms. So what they're trying to do is balance that across the whole grid. So the closer you are to a weather station, the more accurate your data will be. There are certain scenarios where you may not have a weather station in your grid. We run into that in the past. We ran into that a lot in South Dakota, where you could be in grid 617 and there's no weather station. Closest one is the next grid over. Well, they're catching a lot more rain, and now RMA is trying to balance that based on local reports as well as what the weather station is landing. So it turned out it wasn't very accurate. Well, as time has gone on, there's been more and more interest. We need to get better weather stations, and we need to get them closer and more together. As you can see, when we go out east, you know, you get to Sarah's area, Illinois, they're covered. And you get out to us, they're pretty spread apart. My parents' place, I'll zoom in here for you. So my folks' place is generally right here. About in 22, we did not have these cluster of weather stations here. Their closest weather station was actually down in Nebraska. So in 22, there was some storms that came through multiple times in his interval and swept kind of through on this level, and it caught this weather station. Meanwhile, all these guys up here where the hand is at completely missed that rainfall. What that meant is guys in that grid ended up getting a way higher precipitation reading because they did not have a weather station that was actually accurately reading that. There was a lot of complaints thrown out, and from there, a lot of more weather stations were added to there. One of the keys that we look for, and we're very appreciative of this as agents, and producers are very appreciative. SDSU has been a huge key contributor in expanding the coverage of weather stations out here, especially in the South Dakota area. There just hasn't been as much federal interest into it. So having some local interest of adding these to make sure we get accurate data has been a huge benefit. And again, the local weather reports and NOAA are also a huge contributor in these. So everybody wants to know, how does the money work? Where is this indemnity triggered? What's the calculation on it? As you can see, there's a lot of numbers on here. I'll try not to bore you with it, but how it breaks down is if we have a county-based value on grazing as $39, and I put a coverage value of 90%, so I want 90% of what that grid's expected is to come in, and I want 120% productivity factor. I don't want the 150 because it's just too expensive for where I'm at. So, but I do want more than what they're telling me. So we get the dollar amount of protection in there. So we take the county base 39, we take it times your 90% coverage and times that 120% value to get 42 and 12 cents coverage per acre. And then we'll just, for easy math, we'll expect that this grid index is 100 and the trigger index would be 90 because we have a 90% coverage. So the final grid index is an 82. And that's where that trigger is going to come in. So the final grid index below the trigger index, so there's an indemnity. So 82 is what came in at the end, but we know that we're at a 90, so we're going to be short. So the payment calculation factor is the difference between the trigger grid index and the final grid index divided by the trigger grid index. That's a lot of index words there, so we'll break it down into numbers to make it easy. We were expected at 90, we came in at 82, so we subtract the 82 and we divide it by the 90% coverage level. Gives us a payment factor of 0.089. And then we already know that we have $42.12 coverage on here. So we take it 42 times 42 and 12 cents times the 0.89 payment factor, there's an indemnity of $3.75 per acre. So you're looking at me and saying, well, that doesn't seem like a lot. Well, if the producer has 1,000 acres of grazing in that grid, and this interval is selected as a 20% coverage, so now we are covering 200 acres for that interval, the insured would get 200 acres times 375, we'll get an additional $750 for those 2 months. Where this helps out is if you are not getting the precipitation you need on that ground, even though that this is and this is again showing a shallow loss, if this thing ends up even at 50 of what it is, and there are some intervals that we've seen, especially last year in 2022, there were some that were extremely dry where they were down to 30% of expected. That means that you can't utilize that ground for as long as you're planning on to get the cattle where you need them to be to bring them to sale. So this is kind of making up a little bit of a difference on here. So even if we see in a shallow loss, you still are going to have some funds come towards you. Some common questions we have on this is the producer owns the land in one name and cattle in another name. It has both a hay and grazing operation. Do they need to be in separate policies? The answer would be yes on that. We need to have the cattle owned by one producer, and the ground would have to be insured by the same person. If the producer owns their own cattle and partners with someone else on the grazing acres, can they both insure the land at 100%? The answer would be no on that. They would have to split that acreage. We would then need a share on there. In this scenario, it would probably be a 50-50 split. You cannot have basically 200% coverage on there. It needs to equal 100%. One of the questions I get a lot too, do I have to meet a stocking rate per acre? And there is absolutely nothing in the language at all that mentions a stocking rate. I have a producer that I'm working with right now who wants to add a PRF. He is an advocate for not overgrazing his pasture. So that was his concern of, do I have to have a certain number? Because I like to get my cattle off early to kind of extend the life and the health of my pastures. And absolutely, we're able to get behind that. And can the insured pick an interval that is prior to when his colonies or his cattle will be in that pasture? And the answer would be yes on that. We pick intervals prior to when the cattle will be out there because we're looking for coverage. We need that precipitation out there before the cattle arrive to make sure that you have enough to sustain for the full year, not only when they're out there grazing. Any questions before I hop into showing you kind of what a policy looks like? Okay. I'm going to minimize this and we're going to hop into, this is one of my insured's policies that he's given me permission to kind of show you how it works on his. So as you can see, he's in Gregory County. And this is one that I was explaining to you where grids kind of cross lines here and how we're taking it and how we're able to take advantage of and spread his risks throughout the year. He has ground in grid 723 along with 23 and 24. And one of the nice advantages of this program is your grazing and your hay ground are actually considered separate grids. So when he has haying ground in grid 723, and he also has grazing in this grid, I'm able to spread that risk out to multiple intervals here. We can have a match if that's what you would like, or we can, if you're like, hey, I want to take advantage of multiple intervals that look like that they've got a really good payment factor, and that's where my most risk is at, we can spread that out. So on here, I'll show you just a little bit. He's got grazing ground in grid 723. We spread this out from the January, put 17% in, March and April, 17%, May, June, 17, July, 17, September, October, 16, and November, December, 16 as well. We kept the coverage level at 90% and the productivity factor at 150%. When we're looking at this on grazing, we want the best that we can get on here. And he's got 283 acres that are actually insurable in this grid. So not a huge amount. However, we wanted to get them included on here. And meanwhile, he has 123 acres on grazing. On this grid, we decided to match what his grazing was because those were the best factors available to him. If we move over into 28,023, you can see that we changed up the intervals. Instead of the January, February, we've now moved it to a March, February, March, and you can see that I changed that percentage of acres that are insurable in this interval. And we've done that across the board. And the same thing over here on the haying ground. And in grid 24, this is the one who has the most insurable acres. This is the one that I'm actually working with him currently on that we're trying to optimize, because there is an interval here that is actually kind of a dud, where July, August tends to be a month, depending on which interval. In South Dakota, we get a lot of crazy thunderstorms coming through in July, August. So that can actually throw your grid completely out of precipitation. And one of the hard things with that is because these are so sporadic and spread out rainstorms, that he could have a rainstorm come way up here and come through that grid, and he would actually get added into his precipitation, even though his ground is south of the river. So with that being in mind, we're looking at changing this and maybe even taking this completely out of his policy, because it's not covering what he's actually trying to have insured here. So that's kind of what his grids look like. I'll show you what his on-leveled analysis looks like. This is something that we do here at Farm Credit Services. I'll show you how this policy works specifically in the grid that has the most acres. So the county base value in Gregory is $23 for grazing ground. And this is why we wanted to move it, and then why the 150% is an advantage here, is we're able to lock that in now at $31 per acre coverage. And this is the subsidy I was telling you about. That's 51%. That's a huge benefit. So for every dollar of indemnity that you have out there, you're only paying 50% of the premium that would cost. So in other terms, like if you had a $100,000 Lamborghini out there, you're getting the $100,000 coverage, but you only get to pay half the premium on there. That's a kind of a no-brainer on there. So kind of working through here, there's quite a few numbers. I'll show you that July, August, why we're looking at, and this is one thing, if you ever sat down with an agent or if any of your family members did, this is what an agent would show them. So January, February, we're seeing a frequency of profit and a frequency of indemnity at a 90% rate right now. The loss ratio on this interval for him in this grid is 368%. So for every dollar of premium that he's getting another $3.68 out of this interval here. Same with March, April is looking really good. May, June comes down a little bit, but that's our wet season. It's also our growing season. So talking with this producer, that's where he wanted coverage. I need to know that my growing season's producing. If we do have a dry year like we did this year, April and May were pretty dry. So we actually did see an indemnity come in May, June, just because of how short May was, even though June ended up being a wetter month. And this is why I kind of am looking at this July, August with him. We're seeing a 0% profit from this policy in July, August. And a lot of that is because that grid tends to get sporadic rainstorms that may not even hit this producer. So we would probably want to spread that risk out. If we know that this one is not working the way that we're wanting it to, and we're only coming in at a loss ratio of 14%, we're going to take that 17% coverage here on the weight, and we're going to spread it out to better producing intervals. And the way that it works is if, yeah, he doesn't have his cattle out there in January, February. However, if I can make the difference up because this one tends to pay more, we're usually shorter in these months, it's going to make up the difference. So if you're not able to get all the grazing that you need in July, August, if we're able to get that loss paid for in these months that do tend to be a little bit more likely to pay, it's going to make up for the difference here. Down here, we show just what this grid looks like for average rainfall from, and we just took 10 years here, so 2013 to 2022. So average rainfall in January, February is half an inch, whereas the expected comes in at an inch and 5/100. So we're seeing almost half. So this average index comes in at 51% of expected on average years. Whereas your July, August, because of those sporadic rainfalls coming in, we're seeing 143% of expected. So what does it look like when we are looking at a net indemnity? So when we spread this out, when we look at January, February, these are the dollars per acre that have been paid out since 22 on this since 2013 to 2022 on this policy throughout these intervals. And then we go back to, hey, July, August, you've been paying, it's been possibly paying a little bit of the premium on here. However, if we spread these out January, February, that's where we're trying to cash in on this. And we move down to here. This is a year by year analysis of where the money has come in on this. A lot of guys are saying, hey, I don't want to pay extra premium on this. It's understandable. However, when we start adding this up throughout the years, we had 2018 and 2019 were wet years. So yeah, you ended up paying premium, but you also had longer grazing periods and there was better pasture out there. For years that we came in short, even poor years, you were still getting $600 paid out for the full year, or $1,400 on here. So you really weren't paying much premium. You did catch a little bit extra on the side, but these years that actually did hurt this farmer, where he wasn't getting the grazing and the efficiency that he needed in this grid, these are the numbers that came in for the full years of payment. So when I have farmers come up to me and ranchers who are saying like, hey, I need a little bit extra and I feel like PRF isn't the right one for me because I feel like I'm playing Cowboy Casino. Yes and no. We are using the data here to optimize it, to make sure that we are getting the best coverage we can to make up for deficits and rainfall. So if we wanted to play casino, then yeah, I would say let's do 50% in January, February, and let's do 50% in March and April. However, reasonable and trying to spread you out through the whole year, we throw out the duds and we optimize you and spread you out in growing seasons, as well as years that do have better paying factors, to make sure that you are getting this to make up for losses that you're not able to utilize that pasture for as long as you wanted to. And with that, I will end it. Are there any other questions when it comes to PRF?
So we'll give you a couple seconds if you have a question. Otherwise, we'll roll into Joe's presentation. I don't have any in the chat box is what I'm saying at this time. So
yep. Thank you guys. It's been an honor. Appreciate it.
Colten's going to hang with us and he'll be here for questions at the end. So Joe, do you want to do your screen share and we'll turn it over to you? You're going to need to, there you go. I say unmute before we get going.
All right, hopefully everybody can see my screen. Again, my name is Joe Reets. I'm the agent and owner of Prime Risk Management located in Chancellor, South Dakota. For those of you that may not know where Chancellor is, we're about 25 miles southwest of Sioux Falls in Turner County. I grew up on a small farm in Clark County, South Dakota. Went to high school in Willow Lake. My dad is still farming there, thanks in part to the slave labor that he gets from his favorite son every year to go up there in the spring and fall to help him plant and harvest. So looks like they're going to have a good year up there. They started out pretty dry, but they caught some good rains in the middle of growing season, and looks like things are going to finish strong there, thankfully. Our crop down here is a little weaker, so we're going to be a little bit short on our crop, but that's why we've got crop insurance as well. So I appreciate Heather giving me the opportunity to speak. We do these meetings throughout the state and throughout the region as frequently as we can, because our main goal is to try to get good information out there. And that's what we're going to try to do today. If you have questions, please ask. My phone number is there. If you want to follow up with questions that you don't want to ask to the group, please don't hesitate to reach out. Or if you've got a group that you want us to come out and do a meeting for you, we're happy to do so. Just a slight disclaimer. Again, these are educational purposes. The RMA book trumps everything I say here, but we feel like it is accurate for the most part. But that is our Bible, if you will, on the rules. So we're going to talk today about livestock risk protection insurance. And before we get into that, this is kind of my precursor that most of the times when we go out to do a meeting, guys are like, oh, geez, more insurance. I need more insurance like I need another hole in my head. I'm already insurance poor. I don't need more insurance. So the first thing we try to do so people will start understanding the risk management value in crop insurance is to understand the value in subsidized insurance products. And we're going to come back to this again later, but the main thing I want you to understand is when that insurance company takes in $1 worth of premium, and again, Colten talked about it on the PRF, it's subsidized at 51%. LRP is subsidized up to 35%. So of that dollar, the producer is paying in 65 cents. The subsidy is paying in 35 cents. Well, what gets paid out is the rates are set up to approximately pay out 85 cents of that dollar. And then the company earnings are 15%. So how is that different than the other insurance that we buy on our home, farm, auto, so on and so forth? On that insurance, that company needs a loss ratio of about 60%. For every dollar they take in, they need to pay their overhead out of that dollar. They need to pay an agent a commission. They got to pay for claims adjusters, underwriters, et cetera, et cetera. So that company is not profitable unless they pay out 60 cents of every dollar that they bring in. So if we were looking at insurance as just an investment account, probably a pretty poor investment. Obviously something we need in case of a disaster, so we do pay for it, but most likely never going to come out ahead on insurance. Crop insurance is different because of the subsidy. Again, that subsidy is going to help that the payment rates on most crop insurance policies fall around 85%, and some of them vary, but we just use that for an example. On top of that 85%, well, most guys say, well, that doesn't leave a lot to pay for all their overhead. Well, they get another 20 to 22.5%. So again, if they take in $1 of premium, they get another 22.5 cents on their LRP policy to pay for my commission, to pay their underwriters, to pay their overhead costs, so on and so forth. The remainder of that, sorry. I just want to try to move this thing so I can read that, but man, struggling. Let me back up here. Again, the subsidy is that 35 to 80% that the government is paying for that policy. So when we look at the numbers, and we'll look at those later, we're going to talk a little bit about return on investment and return per animal. It does make a lot of sense to buy subsidized insurance. So hopefully you can see some of the value there on that, and we'll talk about that a little bit more later. But I'm going to get into the LRP and the specifics of that now. So what is LRP? First of all, it's available on fed cattle, feeder cattle, and swine. Again, it's a federally funded insurance product that again, protects against one thing and one thing only, and that's a decline in the price of livestock. It doesn't cover death loss. It doesn't cover poor gains due to bad weather. It only covers a decline in expected price. It places a price floor under your livestock, similar to a put option. If the actual ending value is lower than the strike price, then at the date of the end of insurance, an indemnity payment is made. Some of the disadvantages of LRP. It's a daily product. So one of the things we really like about PRF insurance, corn and soybean insurance, there's one date during the year, the rates come out, they don't move from day to day. This is a day-to-day thing. So our rates come out at 4 o'clock and they're available till 8:25 a.m. Central Time the next morning. If we don't buy coverage in that 16-hour and 25-minute window, we're out of luck and we're on to the next day and we're at the mercy of the market going up or down, whatever it may be. There may be days when we have limit moves in the market, and thankfully here in the last few years they've expanded these limits quite a bit on the cattle boards that we haven't seen very many limit moves, and that's maybe a good thing. But when there's a limit move on the board, then we don't usually have an LRP option for that interval that day. Again, certain intervals may not be available. We'll talk about this a little bit more later, but they use the board, the Chicago Board of Trade. That's our forward-looking mechanism, if you will, that says this is what cattle are going to be worth 3 months from now, 6 months from now, 9 months from now, etc. If there's not enough volume in a certain interval or a certain month, that interval may not be available on LRP that day. It does add another input expense to your operation, and there's no denying that. Obviously, with the good cattle prices now, maybe we got a little more room for that. But for 7 years there, we're operating at a loss or possibly even a break even, and now we got to add more money to it by buying a livestock policy. Wasn't always appealing. Just another reminder, this isn't necessarily negative, but it's something that needs to be said. Livestock can be sold up to 60 days before your end date. So again, if I've got an end date of December 1st on my policy, I can sell my livestock up to 60 days before that. If I have to sell them further out than that, I do forfeit my coverage. And what they're trying to protect against there is people basically double dipping. If I've got these feeder calves, I plan on keeping them till December. Well, September 1st hits and the market's through the moon, through the roof. I'm going to ship calves. I'm done with them. Somebody else can take the risk on them. Well, then the market falls out of bed and now I end up collecting in December. It's not really what we want the insurance for. So they've got that in there to protect against that. You can sell them before that. You just kind of forfeit your insurance. The big question we get a lot of times is, well, what happens if there's a drought and I have to ship them early? A lot of times that the government recognizes that and they waive that 60-day rule. You can sell them anytime after the end date of your policy. You're going to shoulder the risk in the market. The government does not care, or the policy does not care when you sell your cattle. The policy only cares about the end date on there because it's going to settle on your end date. If you sold calves the week before, the month after, the week after, doesn't matter. It's going to settle on the prices of that end date on the policy. So if you want to keep them after that, you can. You have to shoulder the risk in the market, or if you're going to, normally I sell feeder calves off the cow. I'm going to background them this year. You may want to look at buying another LRP policy if you're going to hang on to them for another 3 months at that time or something, if you want more protection. Some of the advantages of LRP, it's relatively simple. It's pretty straightforward. It's just a price floor. I'm going to look at the quotes. I'm going to find a price floor I like for a premium I like, and I'm going to put it on there, and I'm going to sleep good at night. The federal subsidy is now 35% or higher. It's available every month, unlike the Board of Trade that only has certain months available. So what they do, for instance, is let's say I want to sell feeder calves July 1st. Well, I don't have a July board. I don't have a June board. I've got a May and an August. So what they do is they're going to blend the May and the August numbers to come up with kind of a weighted average between those two numbers for your July dates and your June dates, etc. There's no brokerage fees. There's no margin call exposure. So again, if I'm going to buy a floor and it's going to cost me $5 a hundred, that's all I'm ever going to pay on that insurance. If the market could go up $50, I'm not going to pay a dime more. The market could go down $50, I'm not going to pay a dime more. So it's kind of nice in that part of the thing. What we've noticed is about a $10 to $20 per head savings for a similar priced put. So again, if I wanted to buy a feeder cattle put out there for $260 in March, the LRP is going to be about $10 to $20 a head savings from a $260 put. And that's not to mention your brokerage fee, which again isn't a lot of money, but then also your cost of money really isn't factored into that. So if I'm borrowing money to cover that put option at my broker and I'm paying interest on that, that money is costing me something. This is billed at the end, so I have no upfront cost. On fed cattle, we see about a $7 to $15 per head savings. And again, that varies. Sometimes it's more, sometimes it's less. Talked about this a little bit. Premium is now billed at the end of the contract, so there are no upfront costs. Huge in this one. This is probably the most important one in the last year of LRP, and probably the most valuable part of LRP is it leaves the top end open and it allows the producer to participate in market rallies. I'm going to show you a slide here later that shows just how much this market has appreciated since April, and if a guy were to say, oh yeah, this is a really good price, I'm going to just cover my calves on the board, I'm going to sell the board, the margin calls in the top end that they blew off on that it would be very painful. So when we have these appreciating markets, LRP really works well because it gives you the protection, but it still allows you to participate in that market rally. Because if the market goes up $50, great, I sell my calves, I get that money back. Granted, I'm paying a premium at that time, but that's a great problem to have. The other nice part about LRP is it allows you to cover the exact amount of livestock that you own. You know, if I have 16 calves, I can cover 16 calves. If I got 16,000, I can cover 16,000. And there's some limits that apply that we'll talk about, but you don't have to buy it in 50,000 pound increments or 40,000 pound increments like you do on the board. Feeder cattle, premium is not the right word there. Basis is probably the better word to use. The basis on feeder cattle is a premium in this area, or it's positive. We'll show you what that means later. It's available on Friday evening after the cattle on feed report is published. We usually sell, when we get a bearish report on Friday, we get an opportunity there to lock in the previous report's prices, knowing that the market's probably going to go down on Monday. A new thing that came out here 2 years ago was it can now be purchased on unborn feeder calves, which is nice. We've got some guys right now that price their cattle in August, and they're looking at covering their calves for next spring already on that August board. Again,
Joe?
some head limitations. Yes?
Can I interrupt one quick question?
Yeah.
Regarding the endorsement date, question says, do you have 30 days after the endorsement date to sell and feeders that you do not have to sell?
You do not have to sell your feeder cattle. You can sell them anytime after the endorsement date. The biggest thing you have to realize, though, is your policy is going to settle on the endorsement date. Again, if I've got calves I'm going to sell December 1st, and I buy an LRP policy on December 1st, it's going to settle on December 1st. Now, if I decide at December 1st, and we're going to have a slide that shows this later, that, geez, it makes a lot of sense for me to background these calves until March, I'm going to hang on to them. You can hang on to them as long as you want after that. And again, just realize your risk management is gone, and you may want to re-up your risk protection at that time as far as buying another LRP policy or some other form of risk protection. But you do not have to sell them after that date. It just, the insurance just assumes we settled, we're done, and now you're at the risk of the market after that.
So it doesn't roll to a next month policy or anything like that. It expires, you have to buy another one.
Correct. Yep. And one thing to remember too, the minimum amount of time that you can buy one is 3 months out. So like right now, the earliest we could sell you an LRP policy would be for calves going to market mid-December. So that's that's where, again, if you're going to do that, you're going to hang on to them for a month and you want risk protection, well, maybe that's where the board is a better option than LRP. If you're going to hang on to them for about 3 months, then I would highly recommend the LRP option on those calves again. You know, the one thing just to clarify too is you can't roll up your LRP policy. So we've had some guys talk about doing that this year. So let's say I covered my calves way back in April, and I covered my 599 pound steer calves for $245. Well, we blew through that a long time ago, and now I could cover them for $280. Well, yeah, I'll happily pay 2 premiums if I can put a $280 floor on them. You can't do that because you can't cover the same calf twice at the same time. Now, once the first policy expires, you can put a second policy on there. That is one of the things on the application and on the endorsement that you're checking, is that says, I don't have other insurance on these cattle. Now, again, if you got 200 head and you only got 100 head covered, you could obviously cover the other 100 head too. So, does that answer the question?
I believe it did, yes.
Okay.
Thank you.
Again, some policy head limits here. Again, the most you can do is 12,000 head in an endorsement, or 25,000 head during a crop year. The crop year goes from July 1st to June 30th. So again, if that could be a problem for some of the bigger operations. So this is always kind of the number one slide that I want to make sure everybody's on high alert on, to say, hey, how are these policies settled? Okay, so on fed cattle, the price of fed cattle as calculated will be the AMS, the Agricultural Market and Services Report, titled 5 Area Weekly Weighted Average Direct Slaughter Cattle. The price series is the live basis sales steers 80% choice category. So that changed. It used to be the 35 to 65, and now it's 80% choice plus category. On feeder cattle, they use the CME Feeder Cattle Cash Index 7-day average. So I had a rancher come up to me one time and telling him about LRP insurance, and he goes, well, that's awesome. I'm going to go out and buy every frozen-eared, frozen-tailed, pink-eyed Hereford that I can find, and sell them for $1 a pound, and I'll make a killing on it. Well, we can definitely put LRP on those calves, but the sale price of your livestock really does not directly impact the settlement factor for the insurance policy. We're going to use a national number to do that. And this is kind of what that national number looks like. And this is just one day of that report, where we've got a 7-day average down here. But you can see, and this is an older report back from March, it looks like, but here's all the different sale barns that there's a USDA employee that day that's looking at every grade 1 and grade 1-2 steer between 700 and 900 pounds that get totaled up, and we get an average weight and an average price, and all that gets granulated down into here, into the 7-day average. Oops, the wrong button. Into the 7-day average, and that's what they're going to settle that price on. So again, I might have sold my cattle in Billings, Montana, and oh, yep, here's my 16 head right here. So say my 16 head don't impact that price. Well, it's a very, very small drop in that bucket of that total price, because again, this is one day's cattle. We had 8,091 head on that day that went into this. 38,774 made up that weekly average. So you're taking an average this week of 38,000 plus head to come up with your settlement price. And they have to do that just because, again, otherwise guys would only insure the junk, if you will, and it would not be a actuarially sound product if that happened. So again, being a government program, we cannot keep it simple, and that's where the price adjustment factors come into play. So we base everything off an 800-pound steer, essentially. Well, lightweight steers, they add 10%. Heifers, they discount 10%. A lightweight heifer, they add 10% for it being light, and then they take 10% away for it being a heifer. And then there's some discount factors for dairy and Brahman. So again, the thing to think about is I'm still basing everything is going to start off an 800-pound steer because that's what the Chicago Board of Trade is trading. And it's settling off the average price of an 800-pound steer because that's what's going into that index. So this is where it gets a little bit confusing. And again, unborn cattle, they split the difference between lightweight steers and lightweight heifers. And you can insure those up to 599 pounds. But now you're using 105% of the weight two or the heavyweight steer price. Basis considerations. This is where Joe Reintz, the crop insurance agent, makes it a little confusing. But again, this is probably the most important question. If the average 800-pound steer brings blank, what are my calves going to bring? Do I have the best cattle in the country? They might bring several dollars more per hundred than that. If I've got poorer cattle, and again, somebody feeds them, they're out there, they might come in below that average. But if we know what that basis is, we can kind of predict what we're insuring a little bit more. So this is a great example. So I took these numbers off of Faith Livestock sale from last Monday. And then these are the LRP ending values for that Friday, or no, for that Monday as well, excuse me. So a weight two steer that I could have locked in for $250.88. That's a heavyweight steer. That's anything 600 to 1,000 pounds. A lightweight steer, anything 599 to 300 pounds, is $275.97. Well, if that guy had bought a policy, and let's just say he had 275 coverage on a lightweight steer, and these are his 457-pound steers that he sold them for $352. Okay, let's use a different example. Let's say he had a policy that locked in at 290. Okay, the index comes in at 275.97. He sold them for $352. Does he collect? Absolutely he does, because he's got a 290 floor. The price came in at 275.97. It does not matter what he sold his calves for. So that's where having a positive basis, and obviously you're going to have some slide on a lightweight 450-pound calf as well. But again, you even look at these 630s down here, they're $25 above that basis. So again, that's where we have an advantage, because a lot of times we can lock in a floor and we can expect to sell our calves for several dollars a hundred higher than that national average. So factor that into your cash flows, factor that into your math. But again, it really goes back to this question. If the average 800-pound steer brings blank, what will my calves bring? And we can go in and help you with that, because if you've got your sales receipt from the previous years, we can go back and look several years to say, okay, here's where the index would have settled on that date when you sold your calves last year and the 5 years before that. So we can try to figure out your basis, so on and so forth. Again, heavyweight steers, get down here to these 837s, 812s. Again, this guy right here is at a $16. I'll get this computer figured out one of these days. $16 positive basis just about to that. So you always want to figure in that basis to what you're insuring. That's kind of one reason some guys that don't understand it don't buy LRP. It's because, why would I want to lock in $3 on my lightweight calves for next year? I'm already getting that now, and the market should go up. Well, the market's going to have to go up $25 between now and then, and we're already getting $70 more than that. So again, I just want to demonstrate that basis does matter and the slide does matter. The same thing is if I had some 1,000-pound steers, I don't have any on here, but again, here's an 893. Well, there's a $9 slide in that 100 pounds. And again, probably not the same type of steers, but even that guy that at 100 pounds more than average is still bringing in a positive basis. So we have some guys that background calves to 1,000 pounds. They have to figure in some slide back into that as they're working their break evens. LRP is trending up. As you can see here in 2020, we sold $3 million worth of LRP coverage on feeder cattle. This year, obviously you can see the number, it's over 257 million. Fed cattle, same thing. So obviously the word is getting out on feeder cattle, but we're still probably only insuring about 20% of the calves out there. So there's still a lot of market penetration to be had with this product. There's still a lot of cattle out there not being covered with this product. I'm going to skip over that one. Carry in the market. Man, we're in a great market right now. The market's going to go higher. Okay, why would I want to buy LRP? Because the market's going to go higher. Well, my question is the market going to go up $20 in 7 months? Okay, the cash index as of 9/14 is 251.21. I could lock in an expected ending value for May for 271.34, a $20.13 positive basis. So that's what you're capturing by buying that LRP policy, is that and that positive carry in the market. Just to kind of give you a little bit of a look back, I had this slide in here from a meeting I did back in April. There we had almost $30 of positive basis. We had a 201 floor. Expected bending value in November is 231. Well, we've blown through that by 20 some odd dollars. So that's a good problem to have. The worst thing in crop insurance is to come in right at your guarantee. If we're going to collect, we're going to collect, great. If we're not going to collect, let's blow it out of the water. And that's what we've done with this market, thankfully. This is something I think some guys that normally sell off the cow need to look at. Can I lock in a profit? You know, and again, some of our guys are very conservative and they don't want to buy insurance. They surely don't want to spend $63 per calf. I think buying the highest coverage level has some value, and we'll show you that. But you know, this is for next April. If I'm a guy that prices my calves in the video auction in end of July, April, might be time to start looking at some LRP on those unborn calves. This is the steer price. You can see that we're locking in a floor of $1,829. You take off the premium, you got your net floor. The other thing to look at is if I don't want to spend 63 bucks, I can still lock in a very good price on the lowest coverage level. I can spend 28 bucks per calf and lock in 1683, which should still be a very profitable turn on that. So again, if I expect the market to keep going up and away, I just want to protect against a black swan event, there's options to go lower. Should I retain ownership of my calves and background them? Well, not everybody's set up for that, but we can take them to a custom lot. So this is something I ran for a guy the other day that I thought was pretty interesting. Again, if we locked them in today on 12/14, I could lock in a 599 pound calf for $1,739, or I could lock in an 800 pound calf in March for $21, $27, $28, $388 difference. That's $1.93 a pound. I would say most custom yards are probably going to quote you between $1.20 and $1.30 to put that pound on. So again, retaining ownership, maybe 63 cents. Obviously, there's other expenses in there. Might be something to think about though as a producer. Let's skip through that one. We're going to get through this. We already looked at this. We talked about money in, money out. This is something I think a lot of agents in the world miss, and I think it's something we do a pretty good job on, is looking at the difference between return on investment and return per acre, or return per animal in this case, of the highest coverage levels. So the way this works is at the 85%, the 85 cent expected payout, we're paying in 65 cents of that as the producer. So my expected return on investment is 131%. Okay, if I've got a $50 producer premium, see here. I got this deal on the bottom of my screen. I'd like to minimize. Is there anybody know how to do that? But $50 times the 131% would give you, minus your premium, gives you a return. I think it's about $15. I can't see it on my screen. Again, now if I go down and buy my coverage out, and now I'm getting a higher subsidy rate. Now I'm getting 142% return on investment because I'm only paying in 60 cents. Okay. My producer premium in this case is $18. But as I do the math, now my return per animal is only $7 per animal. So again, that's one of the advantages, I think, to buying the higher coverage levels is we should, once we're in the middle of that actuarial table, make money on subsidized products. Do you want to maximize it or not? That's kind of up to you. Be prepared. So again, we talked about this being a daily sales closing date. We used to have a little more flexibility before this year. You know, we've got a very big footprint in our agency. We cover 13 states, and we do a lot of stuff via email, especially with LRP. Get your application in. The application's never going to cost you anything, but the analogy I like to make, we're putting bullets in the gun. We're not going to go hunting with an empty gun and then see something we want to shoot and then start loading the gun and try to shoot it. We want bullets in the gun. We want our gun to be loaded. We might not ever pull the trigger, but we want to get you through underwriting, make sure we didn't fat finger a social security number or something like that. We can track your targets for you. So again, if I want to say, yeah, when lightweight feeders in September get to 310, I'm a buyer. Great. We track that. And then when it hits that number, we start calling you and letting you know, hey, here's where we're at. Are you interested? And we go. We have to have all the paperwork in by 8:25 in the morning. It used to be a deal where they let us key the policy and we could do it through the mail and give you some time afterwards to get that policy information back to us. Now we have to have it all in at 8:25 in the morning. To give you an example, when that war broke out in the Ukraine and Russia almost 2 years ago now, my phone started ringing at 5:30 in the morning, and I did not stop ringing until 8:55. We used to have till 9 o'clock. There was guys calling at 8:50 that wanted coverage I could not get coverage for because we ran out of time. We just could not get their application through the system and through underwriting in time to reach that target. So we encourage people, find an agent, get an application, get through that step. It's never going to cost you anything until you call that agent up and say, hey, yep, I'm ready to cover my 100 head at this rate, this date, this coverage level, etc. Some other risk management tools, PRF annual forage, a new one coming out in 2024 that hopefully we'll have some more information on at the end of this month is weaned calf risk protection. That's more of a multi-peril type of tool for weaned calves. So we're looking forward to seeing what that entails when that comes out. Other than that, does anybody have any questions?
Any questions for Joe? I do not have any in the chat box, so I believe at this time, Joe, if you could unshare, we'll go from there. So I want to thank everyone for their time today, and to our presenters, Joe and Colton, thank you very much. And to Juan Leaf and Sarah for joining us and introducing themselves today. We're going to do the Ag Dialogues again in October. So if you're interested or have a topic, please let us know and we will get that taken care of. So